Good morning, everyone, and thank you for joining us for our session on reconciliations, which happens to be one of the more technical sessions in accounting, but it's also it's a subject that's dear to every accountant's heart, a finance person or a manager, and if it's not dear to your heart yet, then we'll explain to you why it should be. Okay. So what are reconciliations and why we do them? Our most important reconciliation is a bank reconciliation, or you'll hear accountants referring to it as bank rec. And a reconciliation is simply a verification of all the transactions in our system by matching those transactions to transactions in our bank statement. Why is this necessary and important? Well, every transaction in our organization, in our business, somehow goes through our bank. Whether we're writing a check or receiving a revenue deposit or making an email transfer, or maybe even buying stuff with a credit card, which gets paid through our bank account, sometimes even cash transactions. To make cash transactions, we have to withdraw or deposit that cash into our bank account. And therefore, sometimes you hear a saying, a bank is the heart of a business or organization, right? Because every transaction in a well-run business or even in a not so well-run will hit your bank at some point. Some people also say cash is king, but I think that's a little bit different in the same realm though. So why do we do a bank reconciliation? Well, again, we're making transactions, recording transactions in our accounting system based on the needs of our organization. So based on internal processes, we're writing checks, we're recording deposits, and so on and so forth. How do we know that our records are correct? Well, if the bank is the heart of our organization and everything goes through the bank, if we match all the transactions in our system to transactions in our bank, we've verified that our records are correct and complete. Okay, so bank reconciliation is probably number one procedure to ensure that our records are correct. Your auditors, when they go through your audit and even in the preparation stages, would always ask for a bank reconciliations, because just like us, they know very well that until your bank is reconciled, your records aren't necessarily correct or complete. For the ones of you that have done bank reconciliations in the past, we can all share the experience that it doesn't matter how good and complete you think your records are, you always find something during the bank reconciliation process. Maybe there are some bank charges that are in your bank statements, but we haven't seen them yet, so we haven't recorded them. Maybe there is a check that we recorded in our system, but it didn't get cashed and may never get cashed, right? Or maybe there is a mystery deposit, which is a good thing to get when you get some money coming into your bank account, and now we have to figure out, okay, what is this revenue that came in and we're not aware of, and where should we post it? Okay, so another thing that could happen in our records is our bank balance in the records may not necessarily match the balance on the bank statement. Now, why is that? Let's say we have $100,000 even in our bank at the end of the month. But if we look in our records, we see $98,000. So are my records incorrect? Well, not necessarily, and this is why we do the reconciliation. This is why we agree what we have in the records to the bank. What could have happened is I could have issued a check. So say it was a November month end, and I wrote a check right on November 30th for $2,000. I sent it out to the vendor. So in my system, that check already went through the bank and reduced the bank balance. So instead of the 100,000 that I have in the actual account at the bank, I now have $98,000. So $100,000 minus the 2,000, right? But on the face of it, if I look at my bank statement and I see $100,000 is a bank balance, and then I look at my financial statement and I see bank at $98,000, a question arises: why is there a difference? So a bank reconciliation is a process that's going to explain any differences. Okay. So now, another thing about our bank transactions is in the reconciliation, we have to match every transaction one by one. Why is that? Because in the bank, we can have a deposit and a withdrawal in the same amount, right? So say funding came in for, let's say, $15,000, and then we recorded an expense for that funding for $15,000. So technically, the two $15,000 are in and out, right? So they offset each other. So if I just focus on the final balance, on the green final balance, and I don't go through every single transaction, then I missed recording a revenue of $15,000 and an expense of $15,000. So my financial reporting is now missing that revenue and expense, okay? So when we do our bank reconciliation, it's a simple process where we go and match one by one every transaction in our bank register, in our accounting system, to the bank statement. It can be done manually, so we can manually just in our software there is a reconciliation bank reconciliation module, and we can go in there and tick every transaction manually at the same time, maybe putting a tick mark on a paper bank statement. Now, most software nowadays also allow us download transactions directly from the bank. And in that case, instead of manual reconciliation, we can do it hopefully the more efficient way, where we can match transactions in our system to transactions that were downloaded from the bank. In some systems, it can be taken even a step further, where when you download transactions from the bank, you can actually post them at the same time from the bank download. And when you do that, the system already knows that that transaction is reconciled because it comes straight from the bank download. So it all depends on the system that we're using. And so as an accountant, a manager, a staff member for a program, if you're involved in the accounting process and in reconciliations, it's important to understand all the functions of your accounting software. Because if the software has evolved since the last time accounting process have been established, and now you have the ability to link the bank and work more efficiently and more accurately and more timely by downloading transactions and matching them to your accounting system, whatever was recorded in there, and that's definitely something to explore. Okay. So let's take a step back here and maybe talk about real life examples. So one example I have from my personal experience is when I was a very young student at an accounting firm, I went to do an audit for a big company here in Winnipeg. The company was an electronics business. The controller there, the top financial person, was a chartered accountant, recently graduated from school, and he was a bright person, but maybe a little lazy. So he didn't feel that doing bank reconciliations on a regular basis is an important process. So he came in right before the auditors were out and did bank reconciliations as well as he could for the whole year. And so what happened is some of the transactions he could match. Now the other ones he couldn't match. And what he did is he created this discrepancy account where he plugged all these transactions. And then the total of the discrepancy account, the total of the ins and outs, because remember in the bank we have ins and outs, right? So the total was not very significant, was under $1,000. So he just wrote it off to suspense expense or some other expense, right? And then, you know, I'm looking at that as an auditor, and I feel, you know, this is wrong, right? Because bank is the heart of our business, and we have to really address every transaction that went through our bank. We can't just rely on the fact that the ones that weren't addressed in the bank reconciliations offset each other and come to a small difference. So, and what do? It's my first year there, and I'm working directly with the partner on the file. And I thought about it, and you know what, this is wrong. So I went and consulted a colleague at the accounting firm, and the colleague said, well, it's a small difference. It doesn't matter for the audit. Don't go to the partner with that. That's, you know, ridiculous. We're not going to talk to the client about it. But, you know, my professional judgment at the time said, this is just wrong. Bank reconciliation has to be addressed to the T. So I went to the partner, talked to him about it. The partner was this older gentleman, and he literally started pulling his hair out when he heard about it. And he told me a story that here in Winnipeg, that one of the golf courses that is, you know, one of the prominent golf courses had a controller at some point who was committing a fraud. And that fraud got caught because in a bank reconciliation, there was a discrepancy of less than $10. So I guess the auditor was vigilant. He saw the discrepancy and said, you know, this is not right. Why is there discrepancy in the bank rec? So they opened up the bank rec, and they saw things like money coming in and then money going out in the same amount to close, except the money going out was going to the controller's personal account or a company he created. So a fraud was discovered through going through the bank reconciliation and investigated a discrepancy. And so in my case, the partner was very happy I brought it up. He called the client, he made the controller go back to work and redo all the reconciliations. And he made it very clear that a bank reconciliation needs to be reconciled to a penny. Okay, so that's a lesson I learned very early in my career. So remember, if a bank rec is out by even $1, it could be that there is $100,000 that came in and $99,999 that went out, creating that $1 discrepancy. And now my records are majorly incorrect because I'm not just looking at the dollar discrepancy, but I'm looking at the deposit of $100,000 and a withdrawal of $99,999 that I don't have recorded in my accounting system. Okay, that's just a little story to make the presentation not so dry. All right, so then let's go back to what happens if I have a difference between the balance of my bank in the books and what's on the bank statement. In the example that I gave, there was a check of $2,000 that I issued. Remember, I had $100,000 in the bank and $98,000 in my records as a bank balance. And it was a $2,000 check that I issued on November 30th that went out, but it didn't clear the bank yet because maybe it's in the mail, the vendor hasn't got it yet, and it'll clear in December. So this is what's called an uncleared transaction or outstanding check, outstanding transaction. So what that means is that this is a legitimate actual transaction, but it still hasn't cleared my bank account because of time indifference. So anytime we do a bank rec, we're going to have a list. Like if my bank does not, my bank in the books does not agree to the bank statement balance, then I'm going to have a list of those outstanding or uncleared transactions that explains the difference. So when we've done our bank rec, we've done all the matching for all the transactions that cleared the bank, that went through the bank, it's very important that we go through a list of the outstanding or uncleared transactions. Because what happens is some of the transactions are really legitimate, and especially the ones that just happened really close to the month end or the year end, so the very recent, and we kind of know they didn't have a chance to go through the bank yet. But if we see anything in there that's older than a month or two, and we really have to question why it is there. Because what happens in real life is we issue a check, and then our vendor or employee may have lost it. And then they call us or come see us and they go, oh, can you reissue that check? Or even better, can you send me an email transfer, right? So then we go and send an email transfer, we record it in the system. And because we have very busy professional and probably personal lives, sometimes it just escapes our mind to reverse the first check that we wrote that our vendor employee lost, right? So now what happens is there is an uncleared check, like really an expense and a reduction to our bank that sits in our system that's no longer needed because it's never going to clear, right? Because we paid that person through an email transfer later, which already got recorded, cleared, and reconciled. So when we look at the list of outstanding transactions, definitely pay attention to anything that's older than a month, anything that's not recent. Does it need to be there? And it's important to investigate those transactions to understand what happened, because it could be that it still is a legitimate transaction and the vendor is just being very slow with cashing. Or sometimes, it's our key employee and they may know, well, this month isn't so good for cash, so maybe I'll cash it next month. So they may be sitting on a check and not cashing it for a reason, right? So we investigate every one of those transactions, and if it's no longer needed, we reverse it. If it's still needed, then we know that it can stay in a bank reconciliation and explain the difference between the book balance and the bank balance. Now, all this process that we've described also applies to credit card reconciliation, just because a credit card is sort of your bank account as well, right? Because you can buy stuff using it and it gets paid through your bank account, so it's really linked to our cash. Okay, let's go through some examples of bank reconciliations. Okay, so here is the bank reconciliation. Just gonna wait until it loads. There we go. This is a bank reconciliation in Sage 300. Now, some of you may know that I feel Sage 300 is an older, very comprehensive system, so things don't look as user-friendly in it, and some of the transactions aren't as simple to make. But if that's the system you've been working in, then you're probably really familiar with it and hopefully love it. So in every bank reconciliation, first we have a summary, and then that summary tells us, okay, so we have a statement balance, which is my bank statement. So in this case, it is just over 11 million. And then we have a book balance, which is the bank account balance in my records, right? And that one is close to 11 million, but it's different than the bank balance. And what is the difference? Well, we see here outstanding withdrawals close to $150,000. That is the difference between the two. So on the face of it, it is reconciled because I have a book balance, I have an explanation of differences arriving at the bank balance, my bank statement balance. So now, once I looked at it, I said, okay, this is great. In this older, more comprehensive software, it could be good to go and check that your book balance on the trial balance is indeed what's showing on the bank reconciliation, because in the older software, trial balance and bank reconciliation may not be closely interlinked. So sometimes if transactions change, your book balance on the bank reconciliation may be different than the actual balance in your trial balance for bank account, if it makes sense. If it is different, we have to investigate, right? Because the idea here is whatever is on our financial report, whatever is on our balance sheet, shown as the bank balance, we need to reconcile that to the bank statement. We need to explain the difference between the two balances. So my next step here, say I agreed the book balance to my trial balance, I know it agrees. My next step here is I'd like to review this outstanding withdrawals, just like we said earlier, and see if they're legitimate or if they need investigation, okay? And here I start right away with outstanding withdrawals. And what I can see here is that, now this is the March 31st, 2020 year end. And I can see here that some of the withdrawals are from March and February, which is probably okay, even end of January. But then I see there are some withdrawals that are from October, November, December, some in January. So if it were me reviewing this, I would really go into it and try and see if anything other than late March should still show as outstanding, if it's still legitimate. Looks like in this particular case, majority of the transactions are from March. So, I'd probably be pretty confident about those ones. But say here, I have transactions from end of January. And I would question why they're still outstanding, because whoever I'm paying, most people don't like not cashing their checks or sitting on, a deposit for a long time. They like to deposit money right away. And in particular nowadays, when we use electronic fund transfers and email transfers, right? That just goes through automatically. So I would definitely review and question everything that's earlier than March in here, just to make sure that it's still legitimate and should be outstanding. Okay. Let's go back to the presentation here. So we said we do our bank reconciliations, and it's important to do the reconciliation for every bank account we have. Even if sometimes we have a saving account that nothing happens there, well, in the end, there's going to be interest we've earned, and we want to make sure that's captured in our records so that the balance in the records agrees to the balance in a bank. And then also all our credit cards, it's important to do the same thing, match the transactions. In our credit card reconciliations, we rarely have outstanding items because we normally just record things off credit card statements and hopefully match to receipts that our staff members provide to us. That's any sorts of errors and then transactions that we don't need, in a timely manner, not wait until the year end. What happens when we do a bank rec at year end and we didn't really do much during the year is we may have a list of outstanding transactions that are from the beginning of the year, and now we don't even remember they're there, right? And sometimes those transactions may be very high amounts. So they really make my records inaccurate. Every time I looked at my records during the year, for as long as those transactions that are not needed were there, they could be showing incorrect numbers in my financial reporting, right? Another thing is when you reconcile the bank, you also really look through your bank statement. And if there is any transaction that's questionable, there is a lot of fraud going on with credit cards and even bank accounts nowadays. the earlier you catch that fraud, the better it is for getting it addressed and reversed. Like I said earlier, it's very efficient if you can use a direct download function for bank transactions in your software. If you can't find a discrepancy, so say we've gone through all the transactions, we looked at everything, explained everything, and there is still a discrepancy, what I find helpful is just to step back for a day and then come back the next day and look at it again, because sometimes we get lost in the multiple individual transactions and we can't really see the big picture there. We can't find that one transaction that's maybe explaining the discrepancy. So when you're trying to find a discrepancy, sometimes it's helpful to look at deposit and withdrawal totals. So your accounting system many times would show the totals of withdrawals and deposits for the month, and so will the bank statement. So you can just start with comparing the totals. So, and many times we see that deposit totals agree. So whatever I show as deposits in my accounting system agrees to deposits on the bank statement. And then I just know that it's the withdrawal side that I need to look for discrepancy in. Now, outstanding checks, those outstanding payments are considered stale dated if they're older than 6 months. So this is technically not a law, that's a Canadian business practice. So a bank has a choice not to honor a check if it's more than 6 months old. I've seen though banks cash in checks older than 6 months old, because again, it's not a law, it's just a business practice, and banks aren't obligated to not honor checks over 6 months old. Okay, so it's important that instead of automatically saying, okay, this is older than 6 months and still outstanding, that must not be needed anymore, it's important to look into what happened, right? Maybe the person already got a different payment and we have it double recorded, or maybe they, they're just very slow and they're eventually going to cash the check. So even though it's over 6 months old, it may need to be kept outstanding in our system. Okay, let's talk about another important reconciliation, in particular in First Nations and nonprofits related to First Nations that are funded by government departments. So, and this is the funding of revenue reconciliation. What happens is we receive funding from the government, and it's up to our organization, our management, our leadership, how we run the program, as long as we follow the guidelines and do the reporting. Now, the government departments may not necessarily know what we spend the funds on. They can't verify any of our expenses, and therefore they rely on the annual audit. But what they know very well is the revenue amounts, because it comes from them, right? So Indigenous Services Canada would be looking to agree the revenue amounts we show in our financial reports to what their system says. And so it's very important to reconcile the revenue we have in our system to a report we get from ISC to make sure the two agree, right? Because again, they may not know our expenses and have no way to verify them, but they can verify our revenue, and they will always do so. Okay, so we get a report from Indigenous Service Canada, CMHC, the province, or other funders that shows the revenue, the funding amounts that we've received during the year, or hopefully maybe the total by program, and then we compare to what we have recorded in our system. Any discrepancies, we need to investigate. Now, those discrepancies are rarely from money not coming in, because most of funds and deposits are now through direct deposits, right? They just come to our bank automatically. Discrepancies are normally from misallocation. So maybe we didn't know which program to allocate it to, and we allocated to brand support, but really it belongs to SkillsLink or education, right? And so when we go through the report we get from the government, we really want to make sure that the classification of funding in our system agrees to their classification. So the same programs show the amounts of revenues as the government report. Now, if in your case there are a few discrepancies, in an annual audit, the auditors will reallocate, because it's very important that the audit shows government funds and allocation to programs exactly as it's intended in the funds and agreement. So now sometimes some funding belongs to the current year, but it's not received until the following month. And in this case, we may still want to agree and agree to the funder's report and record all the revenue that belongs to this year in this year. And in that case, we would create an amount receivable or an accrual. Now, even though we may have agreed all the revenue and we don't see any discrepancies, it's still always a really good idea to get program managers, maybe our executive director, or maybe even the leadership to review program income statements, program reports, financial reports, just to make sure that they review the revenue coming in, they review all the expenses and the surplus or deficit, and then they take ownership for it. So if they think any adjustments are necessary, they're the ones initiating the adjustments and telling us to make the adjustments. Last thing we want to do is to, just agree all the revenue and then expenses and surpluses of what they are, and then we send it off to the auditors, right? And then if our program managers never have a chance to review the surpluses, the revenue and expenses, then our financial reports may cause us issues, right? Maybe we haven't captured some of the program expenses in there, maybe not all the revenue was spent, and now there is a surplus that we have to repay or we have to carry over to the future. So it's always a good idea for us in accounting to get program managers and leadership, program staff, whoever has the most knowledge about the programs, to review programs' financial statements and approve them before they're sent to the auditors or to the government. So let's look at a few examples here. So the first example is an ISC funding confirmation report. Many of you may have seen it. Just trying to make it bigger here so we can see it better. But basically, it's revenue listed by program, right? So the functional area here, for instance, we have basic needs, which is income assistance, and in this case, it's related to COVID-19. And then there is the amount of funding allocated program. And if there is any payable at year end, now payable from ISC perspective is receivable from our perspective, it would be right here, right? You'll notice that in this case, there are no payables at year end just because it was COVID year and there were no funds in holds. In the year when there is funds in holds, some non-essential funding may be halted and would show as a payable at year end, in which case we would need to create the receivable to record that funding in our system. So for this particular community, it's the report is 11 pages. So there are quite a few programs that got funding, and it's important that in the accounts and system for this community, the funding would be allocated exactly to those programs that are listed in the funder's report. Okay, and it has all ISC funding for the year listed here. If you don't have access to this report, it's Always easy to reach out to your FSO, Funds and Services Officer at ISC, and they're very cooperative with providing funds and confirmations because they really do want our financial reports done and submitted on time. So another example for revenue reconciliation or revenue confirmation is, actually it was right here in the PDF. So it is a CMHC subsidy confirmation. So some of you that work in housing or just have knowledge about it may know that we receive subsidies for paying mortgages from CMHC. It goes by different stages or programs, and at year end they send this confirmation report to our auditors, and hopefully with a copy to ourselves. If not, we can always ask for it while doing the audit prep, and then it shows the amount of subsidies that we received for different phases, for different programs within CMHC. And again, this is where we would go through revenue, CMHC revenue in our records, and make sure that the totals in our records agree to this report. So it's pretty simple, it's pretty straightforward, but it's very, very important because remember, your funders, that's the only thing they know, how much money they gave you. So they will always check the revenue against their system, against their report. Okay, so what other types of reconciliations we can we need to think about and perform in our systems? So one of the frequently overlooked but more important ones is loans between programs. So say I have a band department and education department at my First Nation. So the band lends education department $100,000 and records it as a loan. Now, in the education department, I have an accountant who may not be very experienced. They see a deposit coming in of $100,000, and instead of recording a loan payable to the bank, they say, oh, it must be a fund and deposit. So they record it as revenue in their system. So now education is showing revenue of $100,000 more than they actually received, right? And then their surplus is up by that $100,000 because revenue goes straight into our profit. And it is incorrect. And how do we catch that? Well, all the transactions between departments go through either loan to, from, or due to, from, or maybe receivables and payables accounts. And what we do, we reconcile transactions in one department to transactions in the other department. Most efficient way to do it is to print out the list of transactions for each department, and then for the two accountants to sit together and tick off the transactions, right? So in this case, when we do reconciliation, the band accountant would see, okay, you still owe me $100,000. Where is it on your list? And it's not going to be on education list because they recorded it as revenue. So then they're going to have to go and check how they recorded that deposit and say, aha, this isn't supposed to be revenue or surplus. This is actually a loan. And then they reallocate it. And now both sets of records are reflecting that transaction properly and they're correct. Okay, so this happens to be the item that doesn't get addressed at year end for the year end audit very often. So when your auditors have to reconcile those loans between programs, they're going to charge for it. And auditors' hourly rates are way, way higher than our staff rates. So it's really important for keeping the cost down, for keeping the audit time and reasonable. It's really important that we do those reconciliations internally. Now we keep it until year end to do the reconciliation. Now we have transactions for the entire year, and it could be a big project that people really don't want to do and then doesn't get done. So if you can do it monthly or at least quarterly, that's really helpful. Okay, now some organizations make the choice to repay all those loans before the year end, just so there is nothing really to reconcile or worry about as far as interdepartmental loans at the year end. In most contribution agreements, in particular an ISC contribution agreement, loans between programs are allowed. So there's no issue if, say, the band lends to education in this case, right? Or in my example here, social assistance lends to the band. There's no issue for as long as it's accounted for and there is a repayment plan. Okay. Our next item here, it's not quite a reconciliation because we're not reconciling to an external document, but it's a very important accounting procedure, which becomes a part of all our reconciliations and matching processes that we do for month end or year end. And this is our payroll advances. So it happens to be one of the other items that gets unaddressed, and there can be a balance carrying forward throughout years. There can be many transactions in there that have never been reviewed. So it's really important to check your payroll advances account and kind of make sure that at year end, quarter end, or maybe even month end, you know exactly which employees owe how much to the organization. It's also a good process to have a rule in place where all payroll advances have to be repaid by year end. So you don't have to worry about working through payroll advances at year end. Okay. What happens many times is it maybe is a smaller amount in the grand scale of things for our audit in the first, second, third year. So we kind of don't quite look at it. By the time we start looking at it, the balance has grown. And now this is payroll advances as a receivable, right? It's a loan to our employees. The balance has grown, but it may go back a few years, right? And when we start looking through it, we may find that some of the employees are no longer there and they may never repay those payroll advances. Therefore, it's important to look through payroll advances on a regular basis, for sure for the year end, and maybe have a policy in place where everyone has to repay by the end of the year to prevent losing money because your employees are no longer there, right? Or for some other reason, we can't collect it anymore. So one of the processes that I found helpful is here. I'm going to share an Excel report with payroll advances. So I have a GL printout or export to Excel with all payroll advance transactions here. And I'd like to know how much every employee that borrowed money from the company here owes me at year end, right? So what I can do once I've exported to Excel, I can just select all my data. And then I go data, sort, and then here I can sort by name. So now Excel helps me sort the advances by employee name, and I can hopefully easily see how much every employee owes at the end of the year. So for instance, Amber here, if I just select everything she borrowed, okay, you'll notice in Excel at the bottom here, it shows the sum of transactions that I selected. And you'll see that she actually has a credit of $2,700, which I may want to investigate. Now with Mary, on the other hand, let's see what's happening here. Mary seems to be borrowing a lot. So with Mary, there's again a credit of $6,000, which I would want to investigate what happened here. Okay, and so you'll see here credits, that means repayments. But in the end of the day, I have a positive balance in employee advances. And why is that? Well, because there is an opening balance of $10,000 in my employee advances. So for me to figure out what actually happened, I now have to go back to the past years and see if the employees here have repaid everything, or if anything still remains outstanding. And this is also to illustrate that it's an easier process if you have a procedure in place where they have to repay everything by the end of the year. So we never have to go back and try and figure out what happened. Okay, and then another part of what we want to do as a part of our month and year end, quarter end reconciliations. In particular, this one is important for a year end, is pay some attention to our accounts payable. So again, it's not quite reconciliation per se, even though we could receive vendor statements and kind of match our records to vendor statements, which would be reconciling our payables to vendor statements. But what's also really important is sometimes we don't get vendor bills until after the year end. And so it's good to question whether more bills are coming. Maybe we have direct communication with vendors. Maybe we ask our program managers or whoever is responsible for running the programs. Or maybe we establish a communication where we just call the vendor. Sometimes we're working on our year end maybe 2 or 3 months after the year end. So we may be able to review what was received after the year end that belongs to the year end, and just to make sure that whatever belongs to the year end is recorded as a payable and an expense within the year it belongs to, right? Because this is one of the other processes that make sure our records are accurate and complete. And it also gets overlooked sometimes, in particular if you're not worried about repaying a surplus, right? Because if we're worried about repaying a surplus, we'll be actively looking for all these payables, for all these expenses that belong to the program. But sometimes we're not necessarily worried about the surplus. It's still important to get those payables in the period that they belong to in the related expenses. And our auditors will always test for that. So if we're proactively addressing those payables, then we're ahead. There's less work to do for the auditors, and there is less audit adjustments, which make everyone's life easier and also show that our internal records are correct. All right, that's all I had on reconciliations. Thank you for your time.